Lately, stablecoins have been grabbing a lot of attention, with major banks and payment giants stepping
Mm-hmm,
in.
indeed.
It's like they're no longer just a crypto niche, it's mainstream now.
Absolutely. And what's fascinating is how traditional institutions like Bank of America and JP Morgan are not just dabbling, they're launching their own stablecoins to streamline transactions, right?
Yes, exactly. And with players like MasterCard and even Visa joining the buckle, it seems that stablecoins are being positioned to integrate seamlessly with the global
Yeah, for
payment
sure.
rails. They're pushing for on chain spending without extra conversion steps.
So the scene is changing quite a bit. But what do you think is fueling this renewed interest?
Well, regulatory clarity plays a huge role. The US and Europe have been outlining clearer guidelines, and even the UK is consulting on rules. It's kind of like finally setting down a roadmap that reassures banks about stablecoin use.
Mm-hmm, that makes sense. Regulatory advancement does bring a level of confidence that's been missing for a while. But aside from that, there's an intriguing diversity in how stablecoins are built, right?
Totally. We've got the traditional centralized fiat collateralized ones, where a company holds reserves, similar to a bank vault. Then, there's crypto collateralized ones like DAI from MakerDAO, which aim for decentralization. And also, algorithmic uncollateralized stablecoins that adjust
Yeah,
supply
quite the
through smart
spectrum.
contracts.
That spectrum is just fascinating because each mechanism has its quirks. For instance, the algorithmic stablecoins remind me of central banks setting policies, only it's run by code rather than an institution.
Exactly. It's like a digital version of monetary policy, and yet without a central bank's credibility. The central question becomes, how do you instill stability without central oversight?
Right. Mm-hmm. Speaking of stability, there was a mention of USD and its use of delta hedging with futures to maintain the dollar peg, right?
Yes, and that's a great example. USD uses short and long positions to generate a 27% yield, which is significantly higher than the typical 12% yield from other stablecoins. But of course, that higher yield points to higher risk via
Mm-hmm.
derivatives.
Lots of risk indeed. And isn't that a bit ironic? Stablecoins are meant to be, well, stable, but then using derivatives introduces volatility risk.
Indeed, and this is where the design philosophy becomes critical. The idea is that you want to peg to a stable asset, like the USD, but if you peg it to something volatile or rely on risky derivative positions, you potentially undermine that stability.
Yeah, exactly. Which brings us to the elephant in the room, the infamous Terra case. The collapse of Terra wasn't about reserve shortages, but was primarily triggered by fraudsters, right?
Right, Terra USD and Luna's mechanism was unsustainable because it lured traders with exorbitant yields through the anchor protocol, essentially creating a Ponzi like system.
Mm-hmm, that was a dangerous game. That whole setup showed that extremely high returns, like that 19.5% staking yield, just aren't sustainable long term. It set the stage for manipulation and fraud.
Exactly. And we saw legal repercussions too, like Do Kwon facing multiple charges. It really underscores the importance of proper regulatory oversight to prevent future incidents.
True, true. But here's something I keep thinking about. How do you balance the decentralized ideals of blockchain with the need for regulation to keep these systems safe?
That's the $1 million question, isn't it? On one hand, decentralization is the heart and soul of Bitcoin and blockchain, aiming to remove middlemen. On the other, centralized stablecoins tend to offer security and, well, a bit more predictability through regulation.
Mm-hmm, I see your point. Although I must respectfully challenge that a bit. The push for entirely decentralized stablecoins might sacrifice needed stability for ideological purity. What's your take?
That's a fair critique. It's like trying to run a marathon without any hydration stops. While the idea of a fully decentralized algorithmic stablecoin is enticing, it may overlook practical issues like, fraud prevention
Yes, indeed.
and ensuring sufficient reserve backing.
So, what seems to be the emerging consensus? It's a trade off, isn't it, between decentralization and adhering to conventional financial safeguards?
Precisely. The stablecoin ecosystem shows us that while the original crypto ethos was about removing intermediaries as the market grows, integrating a bit of oversight can actually lead to a
Robust
more
indeed.
robust financial system.
And with traditional institutions jumping in, perhaps we'll see a hybrid approach where you retain some decentralization benefits, but also enforce rules to deter fraud and manipulation.
Yeah, exactly. The future might lie in a model where algorithmic mechanisms offer decoupling from centralized control, while regulators step in to ensure transparency and accountability.
Right. It's almost like trying to have your cake and eat it too, isn't it? You want decentralization without the unpredictability, but then you need safeguards which might ironically recreate centralization.
That's a great analogy. It's like when you're designing a car. You want it fast, but you also need brakes to ensure it doesn't crash. Balancing innovation and safety is
Yeah,
key.
exactly. And we've seen how Terra's crash was a catastrophic failure of that balance, with the incentive mechanisms going overboard. That serves as a stark lesson for today's stablecoin pioneers, right?
Absolutely. It tells us that over-yielding incentives can invite risk that completely derails the stability these coins are supposed to offer.
A hard lesson indeed. Plus, it's a reminder that even in the crypto space, the age old principles of finance, like realistic yields and risk management, still apply.
Exactly. And while there's a lot of innovation, we need to remember that stability is paramount when you're dealing with assets that underpin real-world transactions.
Right, that's key. So, as traditional banks, fintech, and payment giants continue entering this space, do you think we'll see a shift towards the adoption of a more hybrid stablecoin model?
I believe so. With legislative frameworks emerging, it's likely that we'll have a mix. Centralized stablecoins that are fully regulated, and possibly new decentralized forms that have built-in guardian mechanisms.
Sounds like a balanced approach. And that would hopefully address both the need for efficiency in transactions and the original vision of blockchain freedom.
Precisely, it's a delicate evolution, but it seems the industry is moving towards ensuring that these digital currencies don't lose their original promise while mitigating the inherent risks.
Yep, exactly. It's interesting to think about how these developments might influence global finance in the long run, especially once we see more mergers of tradition and digital innovation.
Absolutely, and it's this blend of regulatory drive and blockchain innovation that might finally bridge the gap between mainstream finance and decentralized technology.
That's the future we're looking at. At the end of the day, the bigger takeaway is that stablecoins, stable or not, are a work in progress. Their evolution tells us a lot about balancing innovation with protection, an ongoing challenge in finance.
Exactly. And as more major players and regulations enter the scene, the lessons from past failures like Terra will hopefully guide better design and oversight.
Right, indeed. It's an evolving story, one where critical dialogue, measured risk, and a hybrid approach might just lead us to a new era of digital finance that truly embodies both stability and innovation.